Hey, what's up guys? John here. The CEO of America's largest bank just issued a dire warning to all 330 million Americans.
You are going to see a crack in the bond market. It is going to happen. I'm telling you it's going to happen, and you're going to panic. I'm not going to panic.
But what he's saying and what he's doing alongside Warren Buffett, Jeff Bezos, Elon Musk, Mark Zuckerberg, all the billionaires, it's something we all need to follow very, very, very closely, because when in history have we ever seen all the billionaires moving in this direction and then everyone else moving in this direction and the people moving this way are right? Never. The rich always get richer. That's the law of the land. He is warning right now that we are going to see 8 to 9% mortgage rates.
I just tell people, be prepared for higher rates and slower growth.
7%. Are we really going there? And how does
I don't know. When I said 5%, they said, are we going there? Yeah, it's possible. Can it go to 7%? The answer is yes.
We're going to see the 10-year hit 5% and a massive credit crunch inside of America. Now, what is an asset worth? Land, a business. An asset is worth what the highest ready, willing, and able buyer is prepared to pay for it. It's not what the seller. The seller will set the listing price, the buyer will set the buying price. And if we're walking into a credit crunch and you got all these billionaires liquidating tons of their stock the last couple of years, sitting in billions and billions of dollars in capital, what are they going to do? They're going to multiply their wealth inside that credit crunch. And that's what I believe is about to happen in this video. I'm going to break it down and show you exactly how this is going to work out step by step, at least according to the data and information that we have available. Please hit the like button. When you do, YouTube will share the content, educate more people what's really going on in the U.S. economy. Take a look at this. This is why Jamie Dimon is always so gloomy on the U.S. economy. And he breaks down how he sees the 10-year basically going to 5%, 224,000 views here. If we hit a 5% 10-year, we're going to see mortgage rates skyrocket north of 8%. In addition to that, we're going to see lead to a pullback in investment, hiring, and consumer spending. Now, what this to me signals, and also higher borrowing costs for businesses, this is going to put more pressure on small businesses. These small businesses are going to have higher borrowing costs. They're going to have less customers coming in because more customers are going to be, they're going to be more careful with the limited dollars they have. They're going to be spending more money online. They're going to be price shopping everything. They're going to be looking very, very carefully on how they could save every single penny. This is not good for a small business that does not have economies of scale. They have high-priced labor and high expenses. So a lot of these small businesses are going to be going out of business. But then goes one step further. What is a retail strip center worth? The retail strip center that occupies the space of this small business is worth what a tenant is willing to pay. If you have less small businesses available to occupy that space, the value of that asset continues to erode. Now, when the value of that asset continues to erode and borrowing costs continue to go up, who is sitting on that loss? It's going to be the bank. It's going to be the lender, right? And so this is a ripple effect. It's not just the employees at that small business, the small business owner. It's not just the owner of that retail center. It's not just the bank. It's going to ripple throughout the entire economy. And that's just one small example of how this situation on the 5% on a 10-year could hit us. Another really big example is when you look at Airbnb in 2020 and 2021. Even a step past that. In 2020, everyone was leaving LA, San Fran, New York City, Philly. They were leaving these expensive cities, these highly regulated cities where people are like, hey, look, I want to leave. I can work remote now. Let me go to Boca Raton. Let me go to Tampa. Let me go to Austin. Let me go to Nashville. Let me go to one of these areas. I can borrow money. It's free money, 3% for a 30-year fixed rate mortgage. I'll buy $1 million house. I'll put 150 grand, 200 grand down, and I'll borrow 750, 800, 850 grand at 3%. Mortgage is 3,500 bucks. I can afford that. My rent was 4 grand, 5 grand. That's the way in which people looked at it. And so they bought these homes in these areas. And as they did this, what happened? Rates continued to move up. Slowly and slowly, but they did. And then other people started stepping in right after that saying, you know what, marry the house, date the rate. At that time, mortgage rates were 5.5%, thinking they were going to go back to 3. Never happened. So you got a lot of people locked into their homes with those 3% mortgages, their 4%, 5%, 6% mortgages, thinking rates were eventually going to go down. But now you have a lot of people with no way out. Then these big businesses and medium-sized businesses started saying, look, we need to find a way to get rid of these employees but we have to do it in a way that's going to be cost effective. Let's say they have to come back to the office. And so a lot of people needed to quit because they now had a mortgage in Boca. They had a mortgage in Austin. So they had to try to find a different job. So they quit their job and they tried to find a different job. And it was this never-ending cycle that just put more and more and more Americans, one decision after the next, into more debt. And so what is likely going to happen is you're going to see a lot more financial stress unfolding inside of the U.S. economy. And it's going to present a major opportunity to those that have access to capital that can go out there and buy. I think you're going to see some incredible buys in places like LA, and incredible buys in places like San Fran, in these expensive cities in the next couple of years. Because you start to think about this, if insurance continues to rise, insurance is getting more and more expensive because replacement costs are going to continue to go up. Inflation is going to likely get worse. Borrowing costs going up. The cost of living in these cities is likely going up. What is this going to mean? You're going to have less amenities in these cities. They're going to become, less desirable and attractive. There's going to be less employers offering jobs in these cities, and there's going to be less reason to be there. And so you could see a scenario where you could go out there and step in and buy some incredible deals at bargain basement prices because of the chain events likely unfolding. It says big picture, soft landing may not be guaranteed. Inflation risk may persist. Investors betting on imminent rate cuts may be mispositioned. Markets and the Fed may diverge more than people expect. And so it's like, then I saw Jamie Dimon said literally 4 hours ago that there's a crack in the bond market is coming. This isn't some fear monger. This is literally the CEO of the biggest bank in America. And so I'm like, okay, well, if that happens, what happens next? It's like, oh, yield spike, prices plummet, bond market crack usually means disorderly sell-off, treasury yield surge, think 10-year at 5.5%, and liquidity freeze. If the bond values drop rapidly, margin calls explode, liquidity vanishes, think 2008, or UK's pension crisis. And they're talking about mortgage rates going 8-9%, new buyers vanish, demand craters, home prices begin to correct sharply, especially in expensive markets. Yep. Credit crunch, lending dries up, auto loans, business loans, personal loans, all slow. Bank risk models tighten, small businesses and consumers struggle to refi or access capital. Corporate default spike. Now, there's $2.2 trillion worth of corporate debt that was borrowed the last couple of years at lower rates that has to get refinanced over the next 18 months. What's going to happen if rates are at 8%, right? If the 10 years at 5%? A lot of these companies, they're going to be going out of business. A lot of the employees that are working at those companies are going to be going with them. And it says many will default, go bankrupt, unemployment rises as companies cut jobs to survive. And what I think is very likely going to happen here is that they're going to walk us into a crisis, and then they're going to say, look, we need to cut rates aggressively, and they're going to cut rates aggressively, and they're going to print a hell of a lot of money. And they need to, because we're sitting in $36 trillion worth of debt, $150 trillion in unfunded liabilities. They need a crisis so they can print their way out of it. President Trump indicated he wants to develop Alaska's resources to the fullest extent possible. As you can see in this graph, gold stocks have a tremendous gap to close compared with gold spot price, which has soared. I am bullish on the gold stock sector right now. Bank of America's chief investment officer is predicting a weaker dollar cycle, as you can see in the chart below, with no debt and approximately $3.9 million in cash and cash equivalents as of December 31st, 2024, and a project in Alaska. The sponsor of today's video is US Gold Mining, trading on the NASDAQ, stock ticker USGO. The stock is trading as of early June, some 40% below its all-time high. At its April 2023 IPO, gold was worth $1,930 per ounce. Now gold is trading at an all-time high. Yet USGO's share price is still around its IPO price, down 40% from its all-time high. Their flagship Whistler gold, copper, silver project includes 3 gold deposits with combined estimated mineral resources of 6.5 million ounces of gold equivalent in the indicated category, 4.2 million gold equivalent ounces in the inferred category. One shareholder owns 80% of the company. So this is a very unique scenario. This is Mike Dunleavy, the governor of Alaska, with President Trump, and below with CEO of U.S. Gold Mining Inc. on their Whistler project in Alaska. Tim Smith, the CEO, came to U.S. Gold Mining from Newmont, a 100-year-old gold producer, one of the largest gold mining companies in the world. Do your own homework on USGO trading on the NASDAQ. And so I think that's what we're getting, we're walking into right now. They're saying a repricing of everything, the end of the free money era, the new era where risk is repriced, credit is scarce, and only cash flow matters. So like buying real estate that's producing 10, 15, 20% is going to be where most people want to be, not in a 3, 4, 5% cap rate deal. And insurance goes up 10, 15, 20%, vacancies grow. Any small little deal completely makes any small little issue completely makes the entire deal blow up. People are going to be really careful with their money. And I think that's why you got someone like Warren Buffett, who here says Berkshire sold $134 billion in equities in 2024, ending the year with a cash pile of $334.2 billion, nearly double from a year ago. That's why I think all these billionaires, they're doing what they're doing for a reason. They're going to take their net worth from being worth 5, 10, 15, 20, 50 billion, and they're going to multiply it 3, 4, 5, 10x by buying all these discounted assets, infrastructure, companies. They're going to grow their wealth tremendously in the coming couple of years. You think about the 1031 exchange situation in 2020 and 2021, everyone was selling their multifamily properties to buy cash flowing, income producing deals in places like Florida and Texas, and they were buying these properties thinking that we're going to go back to normal. Now you have borrowing costs that went from 3% to 7%, and they have to refinance right about now. Because on a commercial real estate loan, it's different than a traditional residential home loan where it's fixed for 30 years. Every 3, 5, 7, 10 years, got to go back to the lender. They're going to look at the financials. They're going to want to see the cash flow. They're going to want to look at their expenses, and they're going to underwrite that deal and issue a loan based on the value of the deal now. If vacancies grow, borrowing costs go up, insurance goes up, and the banks are already skittish because of what's happening in the economy, well, they're going to be very conservative on their underwriting, and it's going to put more pressure on these owners. So I think it's going to put those with capital in a really, really, really great position, and those with limited capital, in a corner. So put yourself in a great position, whether that be scaling your own business, maybe you work at a great business or one that really appreciates you, but keep your debt service down as low as you possibly can on the personal side, and invest in your future as much as you can. And you'll be able to really take advantage of this. I think we'll never see anything like what we're going to see over the next couple of years ever again in our lifetime. Let's have a conversation below, and for more information on today's sponsor, you can click the link in the description. Catch you next video.